Other ways of reducing your exposure to taxation is by paying your company income tax early. So if you are a medium scale company and you pay your income tax within 90 days of the end of your financial year, you'll be entitled to 2% discount on the amount paid. And if you are a large scale organization, you'll be entitled to 1% discount on the amount paid, provided you pay within 90 days of the end of your financial accounting year, or 3 months, within 3 months of the end of your accounting year. Then you can also, if you make donations to specific organizations, specific charities, those donations are tax deductible, so they will be deducted before the income tax calculation is done. So such organization includes Christian Organization of Nigeria, the Islamic Education Fund, the Red Cross, the Boys Brigade, the Institute of Chartered Accountants of Nigeria. Those companies are in the Schedule 5 of the Company Income Act. Then when processing your monthly value added tax for payment, you are to net off your tax input. You're to net off your tax input from your tax output. So your tax on your VAT input, you net off your VAT input from your VAT output. That is, subtract the VAT you paid on your purchases from the VAT that you charged your customer on the sales. Then it's the net that you are going to pay to the tax authority. So what we're saying is that, for example, if your VAT on your sales is 5 million naira at the end of the month, whereas your VAT on your purchases was 1.5 million. So what you do is you subtract the 1.5 million from the 5 million to get 3.5 million. So it's that 3.5 million that you are going to pay the VAT on. And note that VAT is on goods and services that are paid for. So it is when your customer has paid for VAT that you're going to pay, you're going to remit those VATs, the net of those VATs, to the tax authority, not on your credit sales. Because if you do for your credit sales, at the end of the day, if the sale becomes bad debt, then you'll be looking for how to get refund from the tax authority, and that usually proves difficult, and it's actually tacky. Then you should also reinvest the proceeds of fixed assets on the same class of asset. So when you sell a fixed asset, for example, say a building, the proceeds from such sales should be reinvested in another building. If you reinvest it in another building, because the class of asset is the same, and as long as the reinvestment is within a year, the capital gain tax derivable from that sale the taxation on it will be postponed till the sale of the new assets. So what we're saying is that if you, for example, if you sell a building for 100 million and you made a profit of, say, 30 million, and you're supposed to pay capital gain tax of, say, 3 million on the asset, if the sales proceed of 100 million is reinvented in purchase or construction of another building, such capital gain tax of 3 million that you're supposed to pay from the profit made on the disposal of that building will not be, you don't have to pay it until you eventually, that is if ever you sell the new building that you bought or constructed with the using the sales proceeds of the previous assets. Then you should also endeavor, another way is to endeavor to collect your withholding tax receipts. Withholding tax is upfront payment of your company income tax or personal income tax. So withholding tax is chargeable on supply or on supply contracts, on director's fee, on dividend. So for supply contracts, those withholding tax receipts, once you collect it, when it is time to pay your company income tax at the end of the year, you will net off all those withholding tax that you have paid from the amount of company income tax you are supposed to pay, so thereby reducing the company income tax you are supposed to pay. Then for the purpose of pension payment is pension contribution is tax deductible, so it is deducted before you calculate the personal income tax or company income tax, as the case may be. And the government the minimum amount of pension contribution is 8%. If you however increase your pension contribution, it is legal to increase your pension contribution, and if regardless of the amount, the percentage of pension contribution you charge or contribute, that is the amount that will be exempted from tax. So if you increase from say 8% to say 15%, it is that 15% that will be tax deductible. So at the end of the day, you're going to be subject to less income tax or personal income tax, and the employee that is contributing the pension will have a higher take home at the end of the service period, at retirement, or at the end of the service period, or when they are leaving the organization. Then apply for your capital allowance certificate. Capital allowance is in taxation is to depreciation in financial accounting. So assets go through wear and tear due to usage and due to time, and they are charged as depreciation in financial accounting and capital allowance in taxation. But in order to be able to deduct capital allowance from your income, you need to obtain your capital allowance certificate from the Ministry of Trade and Industry. So you apply for your capital allowance certificate for qualifying fixed assets. Then invest in industries that the government is trying to promote. So from time to time, the federal government of Nigeria promotes particular industry, and when they do so, they give them things like pioneer status and tax exemption. So for the pioneer period, the company will be exempt for tax for a period of between 3 and 5 years, depending on the approval the company or the industry gets. The petroleum industry enjoys pioneer status, and some of their taxes were exempted. The telecommunication companies, when they started in Nigeria, enjoyed pioneer status and were not subject to tax for their first 3 to 5 years. as well as and right now agriculture is enjoying pioneer status, and the pioneer status of agriculture goes as long as 8 years with effect from this year. So if you want to decide on what organization to invest, you can check which ones are enjoying things like pioneer status or some form of exemption or the other, as approved by the federal government per time. Then when borrowing money from foreign institution, obtain certificate of capital importation. So when an organization borrows finance from a foreign, in other words imports foreign exchange to Nigeria for the purpose of investment, if it obtains certificate of capital importation, by the time it is paying back such finance or paying back interest on such finance, the organization will be eligible to get the foreign currency at the central bank rate. And as we know, for quite a number of years now, the central bank rate is different from the black market rate by a wide margin. So in order to be able to get your loan repayment or interest repayment at central bank rates, obtain certificate of capital importation. Then if you are an investor that is also bringing in foreign exchange, obtain your certificate of capital importation from your bank within 24 hours of the transfer of the loan, so that you can also be able to pay back the loan with funds exchanged at central bank rates rather than at black market rates. Then for companies that are in hotel business, the law allows them to deposit 35% of their income that is received in foreign currency in a dedicated bank account, and when such is done, they are able to reinvest 35% of the income that is deposited in such bank accounts and subsequently reinvested in the expansion of the hotel or building new hotel or conference center. Such 35% is exempted from tax. So you can get exemption for 35% of your income that is in foreign currency, provided it is deposited in the domicile in specific accounts and is used for expansion purpose. Then investing in offshore special purpose vehicle, because of double taxation agreements with some companies. If you invest in Nigeria through special purpose vehicle that is registered in a company that has double taxation agreement in Nigeria, you will benefit from the double taxation arrangement. And more often than not, what happens is that 25 to 75% of withholding tax and company income tax will be exempted from tax. Then invest in business which is whole export. So if you invest in business that is whole export and can prove that all the products or the services are whole exports, you will be exempted from taxation in Nigeria. Then if you make losses in previous years losses can be carried forward indefinitely to we can be carried forward indefinitely. So what that is saying is that if you make loss in previous year, the loss you made in previous years can be net off the profits of the current year, so that it will reduce the company income tax that is payable. And it is just this year that banks and banks and insurance are allowed to carry forward their losses indefinitely. Previously, insurance company could only carry forward their losses for 5 years.